So every month, real estate investors and landlords, they get money coming in from their tenants. That's called rent. And that rent is just sitting in your account before your next mortgage payment or property tax or condo fee comes out. But what if you could use that money while it's sitting in your account and put it towards something that can make you more profits? Today, what we're going to be talking about is something called the cash flow dam. And this is an accelerator, correct? An accelerator that's used with the Smith maneuver,
That's
correct?
right. So for many of you that don't know what the Smith maneuver strategy is, it's a conversion strategy that takes non-deductible interest on your primary residence and converts it to deductible interest. With the cash flow dam added into the equation, we're able to accelerate and make that happen a lot faster. Essentially what's happening every month, we're taking that rent that has come in and immediately we're using it as a prepayment on the conventional part of the mortgage. When the conventional part of the mortgage goes down, the line of credit limit immediately goes up. Therefore, we're now able to draw that money and pay the expenses for our income-producing property. When we're tying in an income-producing property with a line of credit, now that interest becomes deductible. So that is how you can accelerate the transition from non-deductible to deductible interest, and in many times it can drop by about half the time. So at a 30-year mortgage, it can be from 15 years or less. So it really depends on how much the mortgage payment is every month and how much you're allowed to prepay, but you're looking at significantly faster conversion.
That was a lot of information. That was a lot of information. I'm wondering how many people actually got that. But I mean, to summarize, it's you made it
beautiful.
Yeah, it is beautiful. You made it sound very complicated, but also at the same time, it's actually quite simple. It's just about setting up the right systems and automating it, right?
And you don't need to know the minor details of it. You let your professionals handle that. You just want to know that this is roughly what's going on and that you are interested in doing that. If the answer is yes, just hire the professionals who are going to take care of it.
It sounds illegal.
It's not. It's actually well within every single rule the CRA has, which is wonderful. You know, it's just that you want it to be 100% accurate. You don't want it to be 90, because that last 10%, if you make one mistake and the entire thing falls apart, you don't want to end up in that spot.
Right, right. So we're taking the money, again, let's just summarize it one more time, super simple. We're taking the money that's already in our account that we receive for rent, but before we go and we put it directly towards the mortgage payment or whichever else, or while it's sitting there dormant, what we're gonna do is we're gonna use it for something else, which is?
Prepaying your principal residence mortgage portion,
okay,
which is tied to a line of credit that readvances automatically.
Oh, okay.
So as that principal residence mortgage goes down, immediately the line of credit goes up.
Okay.
So now that you're not losing any of your buying power, then you're able to draw that money and use it to pay off the expenses of the rental property.
So that means you have to have a specific type of line of credit, home equity line of credit on your home in order to make that lump sum payment towards it, right?
That's right.
But then you're going to be pulling it right back off of that line of credit afterwards.
Exactly.
Okay, because there has to be money on it. I think if people might be a little confused, like, well, I'm putting my money on my mortgage, I'm making a lump sum payment, how am I getting that money back on? And there's a specific tool that's called the readvanceable mortgage.
That's right.
Meaning you pay it into your line of credit and then you're able to pull that money out of your line of credits immediately.
That's exactly right. So the basis of starting the Smith maneuver is having that type of product. So as long as you are set up with it, it's essentially a way for you to have access to the equity of your home all the time. As long as that is happening, then you can implement the Smith maneuver quite successfully.
Okay. So we're putting a lump, I mean, just visualize this. Maybe we'll even have like a graphic or something like that in there. But, you know, I'm going to take $2,000 and I'm going to make a lump sum payment onto my mortgage, which is going to create a $2,000 of accessible line of credit that I can pull. $2,000 on, and then I pull $2,000 off. So that's a wash now. There's nothing there. But now I borrowed this, right?
For investing purposes.
For investing purposes. The interest that I'm going to be paying on that
becomes deductible.
But it's already a wash. So basically what I'm doing is the interest on my home will become tax deductible.
That's right. So when previously it wasn't, now all of a sudden it is.
Just by putting it on and pulling it off.
You're basically...
It does sound like tax fraud.
Well, it's basically what is happening is you you're making a link between the cost of borrowing, which is the interest, and you investing into something. It can be a rental property. It could also be your sole proprietor business. It could also be some other investment that you'd like to do. Maybe you'd like to private lend your money or whatever you really want
But
to
you
do.
have to invest in something.
You have to invest in
Has
something.
to be for investment purposes.
As long as you meet that criteria, then we can actually do some things and make it happen for you.
That is so incredibly cool, and you can just see, I think now you understand the visualization a little bit more. If you do this every month, what's going to end up happening is all of that interest that you're paying on your mortgage, on your home, that is not deductible, you can convert it to $2,000 every month. Am I correct in saying that?
Plus, also you're doing your regular monthly mortgage payment. So then you also have that portion that becomes available. So now we're expediting and making it happen a lot faster.
So let's say $4,000 a month that you're converting times 12 months, $48,000. I mean, you got a $300,000 mortgage. Within what, 6-7 years, you should be able to convert your whole non-deductible home mortgage into, and then you can write off all the interest.
Forever.
Forever. Well, there you go. I mean, like, it's an absolute, once you kind of start understanding, you're like, oh, wow, why am I not doing this?
It's a beautiful strategy, and I think every Canadian should be using it. The sad thing is that many Canadians start buying their properties with only 5, 10, maybe even 15% down, and in order for you to have access to the readvanceable portion of the mortgage, you need to be at that 20% equity mark.
Okay.
And they're even starting to make those rules a little bit tighter. Sometimes there are issues with having that 65% loan to value with the line of credit and whatnot. So don't just think you can do it on your own. Hire a professional mortgage broker that can actually help you do these calculations and figure out how much can you prepay, how much is it going to become available. You don't want to end up in a spot where you're prepaying the mortgage and then all of a sudden no money is accessible.
Right.
Then you're not going to have enough left over to pay the expenses of the rental. And that's not where we want you to be.
But not only contacting a mortgage broker to get you with the right mortgage product, the right readvanceable mortgage, also reaching out to the right accountant or accounting firm to make sure that you're setting this up and keeping it clean. I think that the most important thing about this whole thing is making sure all your accounts and your line of credits are clean, to make sure that CRA
Absolutely.
doesn't want to go and audit you, and it just complicates things,
And
right?
honestly, because it is a unique strategy that not many people implement, it is a higher risk for review. But just because it ends up in the CRA review, it doesn't mean it's wrong. As long as we have all the backup documents, we can make sure that it passes and it actually, all those refunds are approved for you.
Right. So when you are ready to go get this set up, which I think that all of you guys are by now, if you've watched this far, reach out to Steve Tsonev over at Finngo Bookkeeping and Tax. You'll help them get all set up with
Absolutely.
it, get it all started, and then you can start converting your non-deductible interest on your mortgage to a tax-deductible mortgage. So fun.
That's awesome.